Hello and welcome to CNBC TV 18's Mumbai Newsroom. I'm Sumaira Abdi and you're watching MF Corner. On the show today, we'll chat with Mohit Gang of Moneyfront to talk about looking beyond returns in an equity mutual fund. So what are the other factors which matter? And hi, Mohit, thanks very much for joining in. So, there is this obsession that a lot of investors have with the kind of returns, itna diya, or, I got so much returns. But it's really now time to look beyond returns, right? Because like they say, the past is no guarantee for the future. So let's talk about some of the other factors that matter. And I would think amongst them, the prime would be the person behind the money, right? The fund manager who's actually managing. How critical is this as a factor, and what would you look for here?
Oh yeah, absolutely. Good afternoon, Sumaira. I think, as you rightly said, the time has come when investors actually need to graduate to some other measures and look beyond normal returns, or look beyond something which meets the eye. I would put it that way, that returns is the most obvious thing. It's out there in the open. Everyone is talking about it. Everyone is displaying it. But quite honestly, I think much goes beyond the curtains. So one has to go deeper and look at it. And the first factor, which you rightly pointed out, is the person who's managing your money, right? Right hands, right brain can do magic to your money. Honestly, I think it's the most understated quality or the attribute which one has to look at. But how old is your fund manager? What's been his experience in managing public money? Public money management is a big art. Right, there is a difference between a PMS manager, an AIF manager, and a fund manager who handles a large portion of a retail money, right? And there is a difference between an advisor. So all these differences and nuances have to be taken into account for what is the track record, how long the fund manager has been managing the same scheme, how many cycles of market has he gone through, how many ups and downs in the market has the fund manager seen. The problem today in the mutual fund industry is of plenty. There are so many schemes, so many new NFOs which have hit the markets in the last 2-3 years. And so has the number of fund managers increased dramatically. And in many places, we've seen, Sumaira, that fund houses promote junior level analysts and research guys into the fund managerial position, which to my mind is not suitable. Right. So I think that's one of the biggest qualities one has to look at.
Yeah, you need a certain temperament, like you said, for a job like this. But, like you said yourself, Mohit, that, returns is the most obvious thing. The problem so far has been that we're focused on point-to-point returns, right? This is the 1-year return, this is the 5-year return, this is the 10-year return. We can't ignore returns entirely. So therefore, which is the better return, kind of return or return metric that we should be focusing on?
Oh yes, I think the industry again out there focuses on two matrices, which is less than 1 year, they'll look at absolute returns, and over 1 year, they'll look at IRR, or as you call it, CAGR returns. But going beyond that, one has to look at rolling returns. Now, rolling return as a concept kind of removes the recency bias, which is there in trailing returns. It also removes the distortions which a point-to-point return will kind of bring into computations. So what does a rolling return do? So let's say a 3-year rolling period will mean that you take your returns on every single day, which means if I start investing today, I will count it 2025, 27th of June. Then tomorrow I'll again start my cycle of 3 years, then again day after, and so on and so forth. I'll keep counting from every single day. It can be a daily reset, it can be a weekly reset. And I'll take so many observations for last 3 years and see on how many observations has my fund delivered above average return or below average return. Right, so rolling return will then compute your returns for a 3-year scale or a 5-year scale on every single day basis. It will wipe out all distortions, and it's actually by far the best possible way acclaimed globally to actually figure out which scheme has been doing good. We've actually done this computation for quite a number of schemes, Sumaira. And if you see a few of these schemes and you count the observations, how many of these schemes have delivered less than 0% return on number of observations? So you find that few of the bigger names in the industry actually have delivered less than 0% return on quite a number of observations, right? And there are a couple of those schemes which have never delivered 0% return for last 3-year rolling period return, which shows the consistency of the fund manager is fantastic out there.
Mohit, you said you calculated it yourself. Is that what's expected of the investor too? Because when you're selecting a fund, it's how many will you calculate for, or is it easily available, rolling returns?
No, I think honestly, computation can be extremely tough, Sumaira, and it's not expected out of a retail investor to do that himself. I think the best possible way to do it is to go on to multiple websites, and there are many websites which are available, which will give you very easily the rolling returns of the funds. So I think one has to go onto these websites, and it is easily available without any payment. Also, it's available free of charge. So one has to go there and figure out, and they can also compare between schemes out there.
Okay, so the legwork has been made easier, but there is still some amount of legwork that must be done by investors. Okay, now let's talk about where the investment is made, right? The portfolio. I mean, a scheme is only as good as the stocks it's going to hold, right? How does one go through, what the portfolio is like, and what is important over here to know?
Okay, so few of the key parameters, and one of the biggest one for me out here is concentration or the style of investing, basically, right? So if you see, concentration in a portfolio is twofold. One is a sectoral concentration, and second is stock level concentration. So when we say this, how many sectors are represented in a scheme, and what percentage of the top 10 or what percentage of holding comprises how many sectors. Let's say if 60% of the portfolio is concentrated amongst 2 or 3 sectors, then the scheme is highly concentrated. And if you see that those sectors are more cyclical in nature, then that can mean very high risk and a high probability of scheme giving huge negative returns also when the cycles turn, right? So you have to see how well is the scheme diversified across different sectors and different stocks. Similarly, if you see that the top 10 holdings constitute more than 60% of a portfolio on a stock level basis, then that shows very high level of concentration in few large names. And again, the probability that one large name going here and there or giving you a huge negative return can completely distort the returns of the overall scheme. So you have to see that how well is the scheme diversified, how many stocks and how many sectors are represented out there, and is the scheme well diversified, and is it also not only limited to cyclicals. It has to go beyond the cyclicals and have a meaningful diversification depending on the theme and objectives of the investor.
Okay. Mohit, there are 2 important ratios as well, which you have highlighted for us. One is, of course, the expense ratio and the turnover ratio. How much do these matter in the selection?
Look, again, I pay a lot of importance to these 2 ratios. Honestly, I think expense ratio is one of, again, the most underrated matrices which investors look at. But in the long run, and which is like a very, very long term, like 15, 20 years kind of a thing, the compounding of a scheme's return gets hugely distorted with the expenses the scheme is charging. If you find a scheme in a regular plan which is charging you above 2.5% kind of an expense, that's exorbitantly high. Honestly, I think investors have to be aware that that's actually eating into their returns and delaying the compounding overall. So you have to be wary of that kind of schemes. Honestly, I would prefer that all investors go and move ahead into direct plans, but it's not possible for all investors due to multiple reasons of knowledge and awareness and so on and so forth. So even if you're going into regular plans, you have to keep a close eye on the expenses of the scheme. The second part, which is the turnover ratio, it actually shows the amount of churning in the portfolio, which means how many flips have the fund manager done for the stocks which he or she is holding in the portfolio. So if you find turnover ratios higher than 100%, which means that in a year, the entire portfolio has changed once. Right now, that's too high. If it shows lack of conviction, it unnecessarily increases the costs in the portfolio, basically. And it also shows that the fund manager is actually frequently trading. It can be to deliver higher returns, but that's not the objective out here. The objective of a mutual fund holding is to have long-term vision and to hold stocks for a fairly long while, right? So you will find schemes where turnover ratios are less than 20-30%, which shows the conviction of the fund manager and how well he's convinced about his stock picking ability. So very high turnover ratio above 100% can actually be a big deterrent and is a big, big negative for me personally.
Okay. And finally, Mohit, the size of the scheme that a person is selecting, right? Because, I mean, naturally, the well-performing schemes become more popular, and because they're more popular, more money is coming in, and at one point, they just become too large in terms of the assets that they're managing. At what point does it become unwieldy? And, is it a good or a bad thing to be investing in schemes which are too large?
Look, Sumaira, when it comes to active funds, scale honestly becomes a deterrent after a point in time. Honestly, large caps have now attained that size in Indian market context that they can absorb any kind of amount. But when it comes to mid and small caps, the market are not very deep. To be honest, almost 80% of the market cap is covered by top 100 stocks in the country, right? So now if you go to the small cap schemes, they hardly cover any market cap. There is hardly any liquidity. There is hardly any trading volumes. You go beyond the top 10 holdings in any small cap scheme, pick up the stock and look at the daily trading volumes, you'll hardly find 20,000, 50,000 stocks getting traded, which shows very poor liquidity in these stocks, which means one has to be very, very careful that the scheme has a very small AUM in a small cap kind of a thing. So small AUM is also relative. It keeps increasing with the size of the market and the depth of the market. But in current context, I would mean any scheme which is less than 5,000 crores in small cap is a good scheme, honestly. Out here, a very high AUM, let's say 20,000 crore, 15,000 crore kind of an AUM can be a big deterrent to manage a small cap fund. Similarly, when you go to mid cap, you have to just up the marks a little, but still the AUM becomes quite relevant out there. In large caps, I think the market is fairly deep and one can go any size. Even in flexi cap, I think the fund managers have liberty. They can go any size. And when it comes to passive, size actually helps. The bigger the size, the better the liquidity and better the lower the bid-ask spread. So that becomes better.
All right, Mohit, thanks very much for joining in and for explaining, how we should consider looking beyond returns and where we should look at. Thanks very much.